Most people think of Bitcoin as a savings technology or a spending technology. They don't really understand it as a financial layer technology. But Bitcoin truly has the potential to be the equity layer foundation for the future of finance. We need to maintain home prices, but we also need to increase home affordability. The 30-year mortgage at 6%, and then the 50-year mortgage at 6%, and you see that you're starting to save some money there. It makes it more affordable. So the problem with all of these solutions is that they're based on the traditional system. And when we take this reality and we say, how can we use Bitcoin, not just as a savings technology, not just as a spending technology, but as a financial layer technology? How can we integrate it to solve problems? But remember, half of that is working for you. It's working for you to secure the loan and lower the interest rate. It's working for you to build equity to pay it off faster. Good morning. Is it working here? Everybody can hear me? All right, cool. Happy New Year to everybody.
Happy New Year.
All right. So, oh man. What a great couple of panels to kick off the event, right? And what a great event to kick off the new year. I want to give a shout out to John Drew and Paul and the entire BitcoinDay team for putting together this fantastic event for the Bitcoin community. Thank you guys. So, what makes Bitcoin a pristine collateral? Well, it takes the hardness of gold, which enabled the supply of the collateral base to not be expanded ad infinitum to dilute the value of that collateral base, and it upgrades it to absolute digital scarcity, which removes the potential for further dilution. And then it takes the ease and efficiency of treasuries, which enabled quick and cheap one-day settlement, and it updates it so that you have 10-minute block time settlement. You can send billions for the cost of pennies with no counterparty risk. So by taking the best characteristics of gold and fusing them with the best characteristics of treasuries, we end up with this new digital engineered money. And that is what makes Bitcoin the most pristine form of collateral in the entire world. Now, most people, I think, are Bitcoin, we saw it in the panels today, we're still learning, right? We're at the very beginning of this thing. Most people think of Bitcoin as a savings technology or a spending technology. They don't really understand it as a financial layer technology. But Bitcoin truly has the potential to be the equity layer foundation for the future of finance. Now, hey, that sounds cool, CJ, but what the hell does that even mean? And is this going to solve any problems for us? And I think the best way to answer that question is to look at a problem that we have in the world, present a solution, and let the free market decide if there's any value in that solution. So in the next slide, we're going to see President Trump addressing one of the most pressing problems we have here in the United States, which is housing affordability. Let's take a listen what he has to say. Oh, that's me, not President Trump. Oh, there's my beautiful AI picture. What the hell's going on here? That's what you guys were supposed to be looking at. Okay, cool, we got enough of the AI. Okay, let's start the video. Nope. Please, tech guy, press the play button.
Are you still considering a national emergency over housing?
I'm looking at it.
What would that mean?
There's two thoughts on housing. You have a lot of people have housing that because we have such a strong time and such a strong market there, houses are very valuable. It's a big part of their net worth, their house. I don't want to knock those numbers down because I want them to continue to have a big value for the house. At the same time, I want to make it possible for young people out there and other people to buy houses in a way that at conflict. In other words, you create a lot of housing all of a sudden and it drives the housing prices down. So I want to take care of the people that have houses that have a value to the house that they never thought possible, that have sort of made them wealthy and happy, and especially in their later years. Got to be careful with that. I want to keep them up. At the same time, I want to make it possible for people to go buy houses.
Okay, so what President Trump is highlighting here is the truth about the housing crisis, which is that all of the solutions that currently exist are kind of at conflict. And why are they at conflict? Because there's two issues at play. We need to maintain home prices, but we also need to increase home affordability. And the easiest way to increase home affordability is to just let home prices fall, right? But now we get into the housing conundrum, which is a very political thing. Because look at these statistics. Half of the voting homeowners have more than 50% of their wealth in their home equity. And then 90% of the other half of the voting homeowners, they still hold a significant percentage of their wealth in their home equity. So if home prices were to come down significantly, it would be a political catastrophe. We would lose the midterms, we would lose the next presidential election because people would be voting for change. They would be afraid that their net worth is going down, their retirement is disappearing, and their quality of life and standard of living is at risk, and therefore they need to make change. And what this administration is doing is they've presented some solutions, and they are some pretty radical solutions to give you an idea of how serious this problem is. So of course we've heard of the 50-year mortgages, and there's a reason that we heard it and we're not hearing it anymore, and that reason is duration risk. And I want you to remember duration risk, because I'm sure you've seen on social media the 30-year mortgage at 6% and then the 50-year mortgage at 6%, and you see that you're starting to save some money there. It makes it more affordable. But what they're ignoring, what those social media influencers don't understand about underwriting, is that when the loan is longer term, there's more duration risk, and therefore you have to pay a higher cost of capital. And we can see this in the difference between the 15-year and the 30-year. At a $500K loan, the 15-year, you're at 5.3%, you're paying $4,200 per month, you pay $259,000 in interest, and then when you upgrade or you extend out to the 30-year fixed, you get a 70 basis point hike, bringing you up to 6%, but look at your monthly payment, it drops. You're saving around just over $1,200 per month, making it more affordable, but you're paying a significant amount more in interest cost. And Trump comes out and says, what about a 50-year mortgage? This is what we need. Hey, the 30-year mortgage worked well. Why not go to the 50? But when you add 20 years of duration risk, you're going to get roughly 94 basis points on top of your rate. Look at the cost. You're only saving $12 per month. You're paying more than double in the interest cost. And by the way, the average amount of time you spend in your home is roughly about 10 years. So because of the way of an amortization schedule works, where it's interest heavy in the front, you're building equity in your home at a much slower rate at a 50-year mortgage than you are in a 30. So when you go to move and you want to roll that equity into your next property, the equity isn't there. Again, harming affordability. So the solution is not a solution, which is why we're not hearing it anymore. Next, we move on to the potential ban on institutional investors. And if you define institutional investors as those who own 100 single-family homes or more, those entities only make up 2% of demand in single-family homes. So if you remove that 2% demand, you're not really going to increase affordability. And then if you remove, let's say you reclassify syndicates as an institutional investor, and maybe you only own 10 single-family homes. Yeah, sure, you could drop demand, but now we're right back to the conundrum where those home prices are now falling because the demand has dissipated, and you're going to get that change in vote, and you're going to create that fear within the marketplace. And finally, the most recent solution that's been floated out there is the administration ordering Fannie and Freddie to purchase $200 billion of mortgage-backed securities. This is not free market. This is kind of what Natalie was talking about earlier with this communist banking system. This is a form of yield curve control. And when you buy those mortgage-backed securities, the price goes up, the yield goes down. The goal is to lower the interest rates. But it's not sustainable. There's only $200 billion on their balance sheet, and you're going to have to print money, create more inflation if you want to have sustainable rates through a yield curve control program. So the problem with all of these solutions is that they're based on the traditional system. They're based on the fiat collateral layer, which is absolutely breaking down at the seams. And it's breaking down because since 2020, 80% of dollars in existence have been printed. Let me say that again. 80% of the dollars in circulation have been created since 2020. That is what's breaking down mortgages, bonds, credit markets, insurances, all built on top of a fiat collateral layer where the value is being diminished, where the value is being printed away. Enter Bitcoin, a pristine collateral layer, a layer that cannot be diluted, a layer that is engineered to store value through time and space. And let's just review again quickly what makes it that pristine collateral. Quick, cheap, secure settlement. The engineered money component, absolute digital scarcity with the 21 million supply cap. The halving event and the difficulty adjustment, creating a cost-based price discovery cycle. And then also the ability for the network itself to maintain and regulate itself through the growth and shrinkage of hash rate and difficulty and profitability for miners. So you take these two components, pristine collateral, engineered money, and you piece them together, and it gives us the opportunity to redefine credit. Because what happens when you have a pristine collateral underpinning the system is that you have the Bitcoin equity value layer going up, and then you have the fiat denominated debt burden layer going down. This is an inverse trend. And we can take advantage of this inverse trend to turn duration risk into a duration benefit. And when we do that, that means the duration premium that we saw earlier that you have to pay, it actually turns into a duration discount. And when we take this reality and we say, how can we use Bitcoin not just as a savings technology, not just as a spending technology, but as a financial layer technology? How can we integrate it to solve problems? So today, I'm excited to announce that People's Reserve is officially patent pending on what we call Bitcoin mortgage insurance. And this is a really exciting way of how to integrate Bitcoin into the traditional system to solve problems. So I'm going to compare it to private mortgage insurance, and then you decide if it's a valuable solution or not. So with private mortgage insurance, the borrower benefits are only that you access financing. If you can't put down 20%, you need the PMI, and if you don't pay the PMI, you don't get the money and you can't buy the home. So you only get the benefit of accessing finance. For the lenders, you get decreased risk. Now, they use a third-party insurer, so if you default on the loan, they will recover that loss, which where the risk decrease comes from, but there's no increased yield potential or anything like that. How does that compare to how Bitcoin mortgage insurance works? So of course you get access to the financing, but with each BMI payment that you pay in, it actually gets allocated into Bitcoin. And then Bitcoin goes into an escrow account, and that escrow account is 50% owned by the borrower and 50% owned by the lender. What that means is Bitcoin's engineered design and its compounding annual growth rate is working for you, and you can build equity with your PMI payments. In a regular PMI, you're just paying it to get access, you get no benefits. Well, that means as that Bitcoin compounds its growth for you, you have the potential to pay off your loan early. And from the lender side, you get significantly decreased risk because that escrow account, along with the property title, is securing the loan. And because the lender has 50% of the equity of the BMI, they have increased yield potential. Now, let's see how this translates in a chart. With Bitcoin's current 60% CAGR and a BMI product, 500,000 at a 6% rate, you can pay off your debt in 5.1 years. A 30-year debt slave lifetime commitment is now gone in 5.1 years. At a more conservative 30% CAGR, you pay it off in 8.6 years. Now, let's take a deeper dive into the numbers. And I know this is a very heavy chart, but follow along with me here. You can see across the top, in the PMI column, BMI columns, you have the traditional PMI, you have the traditional numbers, but you have BMI with Bitcoin at a 30% CAGR, conservative, and then you have BMI at a current 60% CAGR. Well, take a look at what happens, the upfront cash outlay. It's a 5% down payment no matter what, so you gotta put the 25,000 down. The big difference between PMI and BMI, you need to make your initial contribution, and we want that 20% equity level, so it's going to be a $75,000 contribution. Now, the monthly costs are exactly the same. You're getting $297 in PMI and BMI, and that payment goes directly from PMI to the insurance, and it's paid all the way until you have your 20% equity and you don't have to pay it anymore. Well, that same payment in BMI is getting put into Bitcoin, and then the Bitcoin is being held in the escrow account so that it can secure the loan and build equity for you over the life of the loan. And this is where the magic really happens. Look at the time for full loan payoff, right? So the time until insurance payment ends, right above that, PMI, you're going to pay that for 9.8 years. You're going to pay that for 10 years. You're getting no benefit. You're paying it for 10 years just to access the financing. With BMI, it's not based on equity. You're going to contribute all the way until the loan is actually paid off. But look at the time to pay off. With PMI, of course, there is no benefit, so it's a 30-year full term. But with that conservative 30% CAGR, 8.6 years, 60% CAGR, 5.1 years. So even with a conservative CAGR, you will pay off your entire loan and own your home debt-free before you even build 20% equity in a traditional product. That is amazing. And if we can maintain this 60% CAGR, it's in half the time. In half the time, you will literally own your home debt-free. Can someone say housing affordability? Right? Does this not play a big role in what can be done? Now, look at the total contributions. BMI is a little bit more expensive. With PMI, you're around $35,000. Over the 8-year period, you contribute $68,000. Over the 5-year period, you contribute $55,000. But remember, half of that is working for you. It's working for you to secure the loan and lower the interest rate. It's working for you to build equity to pay it off faster. Look at the total interest saved. This is unbelievable. This is where the magic happens. You save nothing in a traditional method because you're paying it in full, all $500-something thousand. But with the 30% CAGR, you're saving $324,000. With 60%, $415,000. That is how you solve for affordability. Revolutionary innovation of pristine collateral into traditional products. You cannot solve the problem from within the system that creates the problem. The administration's current solutions are built on top of that fiat layer. It's going to continue to leak. It's not going to solve the problem. A new equity layer can solve the problem, and now we know that because we've looked at the math. But when we move out of this fiat experiment and we move into the world of sound money, we need to make sure, because we can't just print money anymore, right? We need to make sure that both the lender and the borrower are properly incentivized. So look what happens for the lender, who also has the 50% upside on that escrow account. Because one of the big things in home lending is lenders hate prepayments. Sometimes there's a prepayment penalty. Sometimes you're not even allowed to make prepayments. In this case scenario, the lender is making significant returns because of their portion of the equity. That 6% loan that you wrote over the 30-year period, you would be afraid to get a prepayment traditionally. But with BMI, the 6% turns into over 10% APY. And if we have a 60% CAGR, it turns into a 17% APY. These numbers are absolutely insane. And what we see here is that Bitcoin is the black hole. Bitcoin is going to suck everything into it. We had natural money in gold, and it was pretty good. And we had experimental money with fiat currency. And I think we all know that system's been abused, and the problems with it have been exposed. But for the first time in human history, we actually have real money, an engineered money that was strategically designed to leverage the natural laws of economics to empower us, we the people, who are storing our economic time and energy within that asset class. And if we can get people to understand that Bitcoin is not just a saving and a spending technology, it's a financial layer technology. And if we can accelerate its integration into these traditional products, like we saw the insurances, the credit, investment opportunities, all of these things, when they're built on top of Bitcoin, they work for you. They solve problems. Everything else is just an excuse. Thank you guys so much. I hope you enjoy the rest of your conference.